Welcome to my channel. If you want to catch my newest video, I post one every day at 8 a.m. In this video, I am going to walk you through the process of valuing Nuvei stock and analyzing its financial ratios. Become a member and support the channel for 99 cents a month. Get a more in-depth valuation for $9.99 or $49.99. The highest level is $99 for a private Zoom session to discuss financial statements. See the link in the very top of the description. Nuvei was founded in 2003 as Pivotal Payments. It's an electronic payment processing company. It's Canada's largest non-bank payment processor. The company went public last month with a $700 million IPO on the Toronto Stock Exchange. Let's get started with the model. This company has a market cap of 7.5 billion Canadian dollars. That's the value of the company according to the stock market. And they trade at $57.50. And they have 130 million shares outstanding. To get shares outstanding, it's market cap divided by stock price gives you shares outstanding. Let's look at the financials. Free cash flow is how you value a company. You estimate the future free cash flows and then you discount that back to today's dollars. And if you have positive free cash flow, then you could pay down debt, pay dividends, acquire other businesses, or grow your own business. If you have negative free cash flow, you might not be able to do any of those things. And free cash flow is cash flow from operations minus capital expenditures. Capital expenditures are investments in property, plant, and equipment. So this company has positive and fairly consistent free cash flow each year, so that's good. So they're generating more cash than they're spending. Although their net income looks pretty bad, net income is revenue minus expenses. It's the bottom of the income statement. It's your profit and loss. It's good to see they have positive free cash flow, but negative net income means they're passing through lots of losses. If you always have negative net income, eventually you will go out of business. The company's passing through lots of financing expenses, financing debt, financing acquisitions. They do have positive operating income, which is good, but it's going to be really settled down with all this debt and leverage that they're putting onto themselves. Let's look at the revenue. Revenue looks really good. It's growing a lot. It went from 124 million to 316 million in 3 years. Let's look at a capital structure. They have 272 million of debt, 337 million of equity, and they pay 1.9% interest on their debt. And that's the cost of debt because they don't pay taxes because they lose money every year. They have 45% debt in that capital structure, which means they have 55% equity. Cost of equity is 13.8%, and we use the capital asset pricing model to figure that out. In order to calculate the CAPM, we need the beta. The beta is how volatile the stock is relative to the market. And they have a beta of 1.5, so the stock moves about 1.5 times the market. The higher the beta, the higher the cost of equity. And their WACC is 8.52%, which is a blend of the cost of debt and cost of equity. And the WACC is a discount rate companies use when they want to take on new projects. So for example, if they took on a new project that cost them $1 million up front, but they would receive $100,000 of cash flows over the next 20 years, what they would do is they would discount those 20 years of cash flows back to today using the weighted average cost of capital. And if the future cash flows discounted back to today were 1.5 million, they would take on the project because it cost $1 million and they would receive 1.5 million, so they'd be generating $500,000 of profit. But if you discounted the 20 years of future free cash flows back to today and it was $800,000, you would not take on a project because it cost $1 million and you'd be losing $200,000. You only want to take on projects that add value to the company. The WACC is a discount rate we're going to apply to the future cash flows for this model. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's 1.1 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1.1 billion. We divide that by 130 million shares. And we get a calculated stock price of $8.35. They're trading at $57.50, so they're trading at a 600% premium. It's a really strong sell according to the model. Simply Wall Street has them valued even lower at $638, so they're saying the stock is way overvalued. Let's see where the stock has been trading at since it IPO'd. So we don't have too much information. The stock price has come up. It's a really risky stock because they're not making any money. It could turn things around and do really well, but that's the risk you're taking as an investor. Stock price is not based off of how well a company is doing financially. It helps, but stock price is only based on supply and demand of the market. The more people that want to buy a stock, it will push the price higher and higher. The more people that sell a stock, it will force the price lower and lower. The company's financials indicate the stock price is way overvalued, but investors are buying the stock hoping the future of the company is better than the way the company's performing. The stock market is forward thinking, but this is a new stock and it's exciting for people when a new company IPOs. Let's look at the financial ratios. They don't have a good PE. The median is 16.5, the average is 18.4. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative PE because they have negative net income. They have a bad price to sales ratio. The median is 2.0, the average is 4.8. Price to sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. I like to see below 2.5, they're at 23.8. So investors are paying $23.80 for $1 revenue. They don't have a good price to book. The median is 2.4, the average is 5.0. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. I like to see below 3.5, they're at 22.3. So investors are paying $22.30 for $1 book value. Equity is total assets minus total liabilities on the balance sheet. They do have a good interest coverage ratio. The median is 4.1, the average is 14.8. Interest coverage ratio is EBIT over interest expense. I like to see above 2.0, they're at 2.9. So they can cover their interest payments. EBIT is earnings before interest and taxes, also called operating income on the income statement. ROE is bad. The median is 12%, the average is 13%. ROE is net income over equity. They're negative since they have negative net income. Current ratio is bad as well. The median is 1.3, the average is 1.8. Current ratio is current assets over current liabilities. I like to see between 1.2 and 2. They're at 0.8, so they cannot cover their current liabilities, which means they may need to take on more debt. The best way to look at ratios is to compare them to similar companies. I've done videos on Accenture, Broadridge, FleetCor, IBM, Gartner, Leidos, Sabre, Scientific Applications, Teradata, Wipro, and Xerox, all in the same industry as Nuvei. And if Nuvei has a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they all worse in pretty much everything except debt. A lot worse in PE because they're negative, worse in price to sales and price to book. They're much worse in current ratio because they're below 1, the average is 1.2. They have negative ROE. They are lower in debt at 45%, average is 50%, but I have a feeling this is going to go up a lot more soon. Market cap when you convert it to US dollars is 5.6 billion, average is 28.6 billion US dollars. And they don't pay a dividend, the average is 1.5%. So to summarize, I have them trading at a 600% premium. Their ratios look terrible and their financials look a little weak. This is a really risky company to invest in, but they need major funding to continue to keep going. Let me know what you think of the video. Leave a comment. I reply to all comments. And be a member of the channel for as little as 99 cents up to $99. Thanks for watching.